Please go to page 272 of your text. We're going to look at Check Yourself 5.1. Nash Office Supply purchased two Model 303 copiers at different prices. Copier 1 purchased at $400, Copier 2 purchased at $450. NOS sold one of the copiers for $600. That's the sales amount. They sold it for $600. Now we have to determine the cost of goods sold in FIFO, LIFO, and weighted average. So the first in, first out, the first copier they purchased, cost of goods sold, was $400. That leaves them a gross margin of $200, ending inventory of $450. So the gross margin is $200. That's how much they made for profit. Now, since we are in an inflationary environment, the costs are going up. LIFO, last in, first out, the most recent copier they purchased was $450. If they use the LIFO method, as you can see, the gross margin is reduced from 200 under FIFO to 150 in LIFO. Therefore, in an inflationary environment, they will pay less taxes. They'll pay $200 in taxes under FIFO, but yet they'll only pay $150 in taxes under LIFO. So that's when they talk about on page 275, inflation versus deflation. You want to always go with the more expensive cost of goods sold. As you go with the more expensive cost of goods sold, it increases your cost of goods sold, yet lowers your gross profit margin, which lowers your taxable income. So we're going to explore a couple of scenarios here. Right here we have a seafood wholesaler selling to a retail store. And seafood wholesaler, they sell 3 boxes of fish to the retail store. And the boxes of fish being sold are at different prices. The retail store buys off the supplier the first box of fish for $100. They buy the second box of fish for $125, the third box of fish for $150. Obviously, we can tell that this is an inflationary environment. The reason why is the cost of the seafood is going up. Seafood's a commodity, and it fluctuates in price. So this is a very real example. So the seafood store, regardless of what they pay for the product, they run a sale, $200 for a box of fish. Now we want to determine what the cost, the cost of goods sold. We want to look at how the seafood store is going to manage their accounting. We obviously know that with a seafood store, with any store that sells perishable goods, the oldest product is sold first. The oldest product is sold first. As we talked repeatedly on the discussion board about many examples you came up with, which were great ideas, delis, your own refrigerator, bakeries, whatever it might be, the oldest product is always used first. So obviously the oldest fish is going to be sold first in the seafood store. But now we're going to look at how they handle the accounting of the seafood store. So the first thing they do is, we know that's going to have $600. Store sells all 3 boxes of fish for $200 each. Sales are $600. Now we want to look at what the cost of goods sold is going to be. The cost of goods sold under LIFO, it's going to be, we're going to use the last in, first out. The most recent purchase was $450 right here. The third box of fish was $150. We assign the $150 box of fish to all 3 purchases, all 3 boxes. That leaves us with a cost of goods sold of $450. That gives our net income $150. This is in an inflationary environment, okay? As the inflation, as the cost of seafood is going up, we use the most recent purchase. That gives us the lowest net income. Now, let's look at what would happen if we just change this around, for example. We're gonna change the, we're going to go from an inflationary environment to a deflationary environment. So what happens is, this is the first box of fish. Now we're going into a deflationary environment. This is the first box of fish they buy for $150. They buy a second box of fish for $125. The most recent third box of fish they buy is for $100. As you can see, we're operating in a deflationary environment, yet we're still using LIFO. Last in, first out. Okay? Last in, first out. So if you look at the last in was $100 for a box of fish, right here. Sales are still $600, we know that. So $100 assigned to all three boxes is going to give our cost of goods sold only $300. So we take the most recent purchase and assign it to, as a cost, as a benchmark for the cost of all the other boxes of fish. $100, $100, $100. And that gives us a cost of goods sold for all three boxes of $300. And now we sold this fish for $600. Cost of goods sold was $300. Our net income is $300. Now you have to ask yourself, what would you rather pay taxes on? $150 worth of net income or $300 worth of net income? Hopefully you'll say $150 worth of income. Your tax liability will be less. That is why it's important to consider LIFO, FIFO, and weighted average in relation to its either an inflationary or deflationary environment. Now let's go over the same scenario with FIFO and LIFO. Now if we look at FIFO in an inflationary environment, let's go back to the first example here. We're going to look at FIFO in an inflationary environment. Okay, FIFO in an inflationary environment. First purchase, second purchase, third purchase. The first purchase was $100. $100 for the box of fish. Now we're looking at FIFO. $100 for the box of fish, and we assign that cost to all three boxes of fish. So our cost of goods sold is now $300. That $600 for the sales amount minus the cost of goods sold gives us net income of $300 right here. So using FIFO in an inflationary environment, we want to compare FIFO to what would happen in a deflationary environment to see the difference. So FIFO in a deflationary environment. So we're going back up here. Okay, so what's happening is first purchase $150 for a box of fish, second purchase $125, third purchase $100. So we look at the first purchase. The first purchase is $150. First purchase is $150. That's the most recent purchase. And so our cost of goods sold is going to be $450. $600 in sales minus cost of goods sold, $450, is going to give us net income of $150. So as you can see, and then lastly we'll do weighted average. And weighted average is going to simply be the sum of the three, 100 plus 125 plus 150, divided by 3, $125 for a box of fish per box, so it'll be $375. Cost of goods sold $375. $225 is net income. So again, the equation right there, you took the three cost of the 3 boxes, added them up, divide by 3, that gives us cost of goods sold, net income. So now we just want to summarize this. Well, if you're looking at FIFO, for example, as the cost is going up, if you use the first purchase, okay, the first purchase, and the cost is rising, you're going to have a lower cost of goods, or you're going to have a lower cost of goods sold. But if you use FIFO, the most recent purchase, first in, but if you use, so if the cost of goods sold is going up, and use the oldest purchase, you're going to have a lower cost of goods sold. Now, in deflation, if you use the first purchase, which is going to be the most expensive one, in a deflationary environment, the first purchase will be the most expensive one. That's going to give you a higher cost of goods sold, and thus a lower net income. That's how FIFO works. Inflation and deflation. Now we're going to look at how LIFO works, inflation and deflation. Again, historically, there's always been inflation. So for the most part, you'll always see LIFO being used because it's an inflationary environment. So the most recent purchase, last in, first out, is going to give you the highest cost of goods sold, therefore the lowest net income. Now if you use LIFO, while the cost of goods sold is going down, it's going to lower your cost of goods sold and give you a higher net income. So that's how, and then of course weighted average, that could be hit or miss depending what's happening with the cost of goods sold. So that's a quick overview as far as what happens. Again, this is the cost flow, okay? This is the cost flow, and it has nothing to do with the physical flow and the cost flow are two different things. The physical flow we've already established. Oldest fish is going to be sold first, otherwise it's going to go bad. Cost flow is how you assess pricing or assess cost to a fluctuating commodity or service that you're buying and trying to keep tabs on your cost of goods sold. So that's the difference between the two right here. I hope this has been of some help. Please email me if you have further questions. Thank you.